Global stocks, bonds and currencies are mixed and on tenterhooks ahead of key US jobs figures tonight. The RBA governor talks tough against inflation. Malaysia keeps rates on hold, but with a lower inflation forecast, while Thailand's annual CPI inflation falls to just 0.35%. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ economist Henry Russell reviews how New Zealand's housing headwinds might hold back the market as interest rates fall.
Compared to 2015, the broader economy is much weaker than it was. New Zealand's currently experiencing a fairly severe slowdown, reflecting the impacts of past monetary tightening.
But first, in 5 and 5 with ANZ, global markets are mixed this morning ahead of the key US non-farm payrolls numbers. As of 4 a.m. Sydney-Melbourne time, the S&P 500 was down 0.2% and the Nasdaq up 0.4%, while US Treasury bond yields were down between 2 and 4 basis points. The non-farm payrolls data tonight is expected to show 165,000 jobs were created in the United States last month, and unemployment fell to 4.2%. ANZ head of G3 Economics, Brian Martin, says the market is looking for clues on whether the Fed might start its easing cycle with a 50 basis point cut to rates.
Our expectation is that the data should be consistent with the Fed cutting rates by 25 basis points, but we're going to have to watch the data. Were you, for example, to get unemployment moving up quite a bit again and, dare I say it, a negative non-farm payroll number, well then I think alarm bells are going to flash, and that would force a rethink as to whether or not the Fed might need to make a larger rate cut than 25 basis points.
The US dollar index fell 0.3% in line with those lower US yields. That saw the Aussie dollar up 0.2% this morning to 67.39 US cents, and the Kiwi was up 0.4% to 62.25. Number 2, Reserve Bank of Australia Governor Michelle Bullock yesterday sent out a tough message on inflation, warning that the ongoing high rates required to quell price rises might force some homeowners to sell up. ANZ senior rate strategist Jack Chambers says the speech backed ANZ researchers' view that rates will be on hold until February.
There was no real let-up in the idea that inflation is still too high and uncomfortably high from the RBA's perspective. Governor Bullock talked at length about the RBA's strategy to the hiking cycle was quite different to other central banks. They hiked by less. They took the policy rate less above what they think their neutral rate is compared to other central banks. But that naturally also means they probably stay at the same level at their peak interest rate for a longer time period compared to, say, the Fed or the Reserve Bank of New Zealand. In thinking about what will actually get the RBA to start easing, it was just interesting to hear Governor Bullock talk about the need to achieve the inflation target in order to achieve the full employment target.
Number 3, the gap between Australia's exports over its imports rose $600 million to $6 billion in July from June. But ANZ economist Maddie Dunk says there were signs China's weakening economy is affecting demand for key Australian exports.
On the resources side, exports fell, coal and LNG exports were down, and we do expect that softer commodity prices are likely to weigh on the trade balance going forward. One of the notable things was that we saw exports to China were their lowest since February 2022.
Number 4, Malaysia's central bank, the BNM, kept rates on hold yesterday at 3% and talked up the economy's strength while revising down its inflation projections. Here's ANZ economist Arindam Chakraborty on what that means for interest rates.
Going forward, BNM believes that Malaysia's positive economic prospects and domestic structural reforms will continue to support the ringgit. Considering the stable inflation and growth outlook, we think BNM will keep the policy rate unchanged at 3% in 2024.
Number 5, Thailand's annual CPI inflation rate slowed to just 0.35% in August. ANZ economist Crystal Tan says the dip is likely to be temporary, with inflation set to return to the Bank of Thailand's 1 to 3% target band within the year.
In terms of the policy rate trajectory, it's going to be the growth outlook that will have a heavier influence, and much is going to depend on the credit cycle and also the speed and magnitude of incoming fiscal stimulus. Now, on that front, next to watch is the new administration's policy statement that will reportedly be delivered next week.
Crystal Tan there. Now, in our bonus deep dive interview, ANZ economist Henry Russell looks at what might hold New Zealand's housing market back over the next year, despite mortgage rates being set to fall to the gangbuster levels seen in 2015.
In terms of where we sit now, yes, interest rates are falling, but interest rates are just one driver of the housing market. They certainly aren't the only one. And when you think about, the broader economic momentum and the deterioration in the labour market we're seeing, there are still plenty of strong headwinds facing the market that are likely to weigh, at least in the very near term. And that's certainly been what we've seen in the data over the past 3 months. House prices have actually fallen in each of the last 3 months and are down around 1.2% from their previous peak back in April. And underpinning that has been fairly weak sales activity, and sales have not been able to keep pace with listings, which have been rising for some time and are near decade high currently. And so the ratio of sales to listings does suggest that house prices are likely to correct further, at least in the near term. A lower price is likely to be necessary to clear the current backlog in the market. But in terms of what happens moving forward, obviously now with interest rates falling, that's likely to support demand, and we do expect to see house prices stabilise toward the end of the year and a recovery to follow through 2025.
And you say in the note you expect mortgage rates to fall down to where they were around in about 2015. There are sort of different dynamics between the market then and now, though. So what wasn't there in 2015, though, that is there now in terms of those headwinds?
Yeah, thinking back to 2015, the housing market was going gangbusters in New Zealand. House prices were rising or rose around 18%, or annual house price inflation peaked at around 18% in August that year. But interest rates were one part of that, and so one could potentially take from that interest rates around those levels, or mortgage rates around 5.5% or slightly lower, are not restrictive enough to constrain a substantial recovery in house prices. But compared to 2015, the broader economy is much weaker than it was. New Zealand's currently experiencing a fairly severe slowdown, reflecting the impacts of past monetary tightening, and that's flowing through to the labour market. And given that the labour market lags the broader economy, unemployment is expected to continue to rise well into next year, and that's likely to weigh heavily on households' confidence and limit their willingness to borrow and to enter the market. One of the big drivers of the housing market back in 2015 was also a surge in net migration inflows. We have experienced that in New Zealand over the past year, but the migration cycle is turning fairly rapidly currently.
And so a little bit of further dip in house prices over the rest of this year. What do you think could happen over 2025?
So we're expecting house prices to rise around 4.5% over next year, but certainly we wouldn't be surprised if that forecast doesn't come to fruition. It's really a balance of risks. Certainly if we were to see the weak momentum that's been apparent over recent months continue for a little longer, or the domestic economy to weaken more than expected and that to flow through the labour market, the housing market recovery could be much more gradual. But on the flip side of that, house prices absolutely could rise much more than we expect. One of the big unknowns is how quickly confidence returns and animal spirits in the housing market. We could certainly see the return of FOMO, or fear of missing out, if house prices do start to pick up, and that causes a significant increase in activity in the market. But one of the big challenges to a significant rebound in house prices is that affordability still remains very stretched.
Henry Russell there talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, September the 6th. Catch you next week with what tonight's US non-farm payrolls jobs figures might mean for the Fed's rate cut cycle. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.